So now it's our pleasure to introduce our morning keynote speaker, David Weild. So David is the founder, chairman, and CEO of Weild Co, a rapidly growing network investment bank. During his career at NASDAQ, David oversaw more than 1,000 equity offerings, including listings for Facebook, Netflix, and JetBlue.
He helped create the Market Intelligence Desk at NASDAQ, where he was vice chairman and executive committee member. He also headed the corporate finance and equity capital markets at a major investment bank, where he helped develop the first computer system to algorithmically distribute and incentivize investment in primary equity offerings. Yeah, he did. Studies co-authored by Weild helped give rise to the Jobs Act, and he attended the signing by President Obama in the Rose Garden. And he's also an advisor or board member to a number of blockchain companies and regulated trading platforms, including Templum and INX.
David was named to Patrick Young's list of the world's most influential people in market structure and was included in its list of the top 10 visionaries and top 10 startup entrepreneurs. He was called a legendary Wall Street executive and fire starters and is known as the father of the Jobs Act. Now please give a round of applause for our highly accomplished keynote, David Weild.
Thank you. Well, good morning. Boy, it's an exciting time to be working in markets, isn't it? Talk about disruption. Everything is going to be changing. Just a quick, just want to tell you about what we're doing at Weild Co. We took the Wall Street investment banking model and we turned it on its head. So it's in the cloud, not geographically constrained like a traditional investment banking model. And we are, there's so many people because of market structure changes where they collapse trading spreads and commissions. I'm going to talk a bit about that. We've had the middle market investment banks have been mostly consolidated out, and there's a lot of talent out there and a lot of need to effectively provide support services, advisory services to middle market investment banks. So we grew 100% last year in terms of numbers of investment bankers that are added to the platform and seeing some pretty amazing talent coming on board. And we are actually actively out there doing some investment banking work with blockchain companies. So just FYI. That's us. We're going to talk a little bit about the good, the bad, and the ugly of the blockchain, securities, tokens markets. A couple of categories that I just wanted to mention very quickly. One is blockchain businesses, which are disrupting incumbents. Sorry for the typo there. And tokenization of securities assets, packaging for investment. I would like to say that we, very early on, this was before Clayton came out, Chair Clayton, and said that he hadn't seen an ICO that he didn't think was a security. In our investment banking operation, we told everybody, probably 3 months before that we were not going to treat any token transactions as outside business activities, and that we were going to deem them all to be securities. So we were way out in front. And then I subsequently spoke at a conference where somebody asked me, and I think I was a little hostile, what I thought about some of these exchanges that were trading tokens. And I said that I thought that pretty much all of them were probably illegal. And the reason is that this is a regulated business. And if you're trading securities, or you're trading commodities for that matter, currencies, you're going to be regulated either by the SEC or the CFTC, and there's sort of no question about it. So it's also an area that the government, from a public policy standpoint, has a keen interest in making sure that investors don't get burned. And you've seen a number of the articles. I'm going to get to that in a second. But what I see going on in this market, and I think a lot of you who are old enough to know this or probably agree, this feels an awful lot like the early days of the internet, early-ish days of the internet. And it means that we're going to have big up cycles, we're going to have corrections, we're going to have disasters along the way. But the technology is real, okay? It's going to have its kinks worked out. There'll be versions 1.0, 2.0, 3.0. It's real. So it's going to be here for a while, and it's going to be up and down. But there's going to be some big busts. We saw them in the internet. Pets.com, you all remember the sock puppet, Webvan, eToys. Interestingly, for those of you that are in the equity underwriting business, in the agreements among underwriters, there is a provision, a clause that was tacked on because of the lawsuit against Goldman Sachs, where eToys shareholders alleged that if Goldman hadn't underpriced the deal to the extent that they did, that the company wouldn't have gone bankrupt because they left that money on the table. So subsequently, in agreements among underwriters, there was a provision that was added that said, essentially, the investment banks are not your fiduciary if you're a corporate issuer. Kind of interesting. And that came out of the dot-com period. A little bit of trivia. But we're going to see category-defining companies. And these are all companies that benefit from the internet. Amazon, Google, Netflix. The internet enabled these businesses. Facebook, YouTube, iTunes, much of Apple. So I think you're going to, I just think, I know you're going to see this kind of thing repeat itself in the blockchain space. Regulators. This is from the Wall Street Journal. There's a couple of articles out there. I took the Wall Street Journal one because it wasn't as flamboyant. There was one that said that 80% of initial coin offerings there was something wrong with them. But this is a Wall Street Journal article, and there's quite a bit of fraud going on. I think that it behooves everybody in the industry to kind of get their ducks in a row and to start running these transactions and these financings to the standards of securities transactions, private placements, risk factor sections, and so on and so forth, full disclosure. If you read the typical white paper, it's really, really light on risk factors. It's really, really light on what is conferred in terms of benefits to the investor by that token that you're purchasing. All that stuff there's no cap table. All that stuff needs to be expanded upon, and I would urge everybody to get a hold of a really high quality S1, which is the form of filing for an IPO. Look at the sections, emulate the sections when you're out there raising capital, and just do a high quality job. Respect the investor. So what are we selling via securities tokens? There's, on the one hand, ownership stakes and economic interests in operating entities. On the other hand, assets. You're going to see anything that people want to own, that they want to sell an interest in, and that's going to be sold as a token. And we're going to see a sort of a massive shift, I think, from stock certificates and bond certificates as a primary form of ownership to tokens as a primary form of evidencing ownership. The good part is it's theoretically a more efficient way to package and trade securities. It's theoretically going to support innovation in securities formats. And I'm going to give you a little bit of the benefit of my 14 years running an equity capital markets group and raised the first money for BlackRock back when it was still for Larry Fink, when it was Blackstone Financial Management, closed-end fund packaging, real estate investment trust packaging. The market pays a premium for securities that offer monthly distributions, dividends, as opposed to quarterly ones, because retail prizes the money coming into their account on a more frequent basis. And when you start to look at smart contracts and tokens, you start to see an opportunity to pay cost effectively to distribute income more frequently. Monthly versus quarterly was worth, when we did the analysis many years ago, about 6%, a 6% premium to net asset value, so it was real. So in theory, it should be able to drive down your cost of capital as an issuer. So I think the innovation that we're going to see in coupons, dividend frequency, revenue strips, payments in kind securities, drips, all of this stuff can be effectively set up so that securities are basically deposited into someone's cyber wallet, and you're going to see I think a spurt of innovation in the kinds of security tokens that you see in the marketplace. The bad is that today there's still a limited reach to the investor universe. You lack, for the institutional side of the business, custody solutions, and institutions are not going to come into the market in size until the custody problem is solved. There's a lack of cyber wallet integration with traditional securities accounts, and if you think about it, right, Morgan Stanley, UBS, Merrill Lynch, these firms each have about on the order of 18,000 retail financial advisors. And they are not going to stand still, I think, and see more and more assets owned as tokens instead of securities. So we're going to see an integration of cyber wallets into securities accounts at major Wall Street firms. What that is going to end up doing is then opening up this pool of assets so it can be made available to the token market. That's important. So both of those things are essentially gating items that are going to bring cash into the market, and that will fuel, back to the internet chart, probably another leg up in these markets. The legal hurdles, and I'm going to get a little technical here for a second, but under the Jobs Act, once you hit 2,000 plus shareholders, and a lot of these token offerings have had many, many, many token holders, if you will, you have to register, you have to become a fully reporting company with the Securities and Exchange Commission in this country. If you are not, then in the aftermarket, you start to run into a blue sky problem, because if it's the exchange listing, a national exchange, which is right now the NYSE and NASDAQ, that confers upon a company an exemption from state registration. Okay, that's important. Okay, there's also a transfer agent requirement in the rules, and it's rather interesting when you think about it, because in theory, the block should remove a lot of the need for a transfer agent. But right now, until they amend the rules and until the SEC gets comfortable with the token version of transferring tokens or securities, you still have to check that box. It means you have to go to one of the big transfer agents, where you have to register as a transfer agent yourself. And if you want to get listed on a major stock exchange to enjoy the aftermarket blue sky exemption. Hope you follow that. The bad is there's all sorts of platform vulnerabilities. And you just fish this out. I got this thank you, Oscar Jaffrey at Core Connects, who, by the way, I'm going on his board of advisors. There are platform vulnerabilities. There's a lack of governance on quality of tokens and smart contracts. There's minimum standards for contracts. The ERC20 standard only deals with data access and query type of functionality. And you go on and through it, and you start to realize that, that there is going to have to be real scrutiny on the technical side paid to these platforms. If you think about it, right, if you securitize a company through the issuance of tokens, how is somebody going to acquire that company, all right? And does the token essentially allow you to do that, rationalize businesses? And have they really thought through that kind of corporate governance piece of things? And I'm not sure most of these platforms were set up to do that. Maybe the one that right now that kind of springs to mind is the Hyperledger Fabric that was put up by IBM. I think is probably moving in that direction, from what I understand. But I'm not the expert. That's the one that DTC is actually working on, just FYI. And there's no support for managing securities tokens throughout their life cycle. A couple of things, and I went to the general counsel of FINRA with this. FINRA is the Financial Regulatory Authority early on, because when you're running an investment bank, you have to make sure that your bankers are not trading on inside information. So you typically run a watch list and a restricted list on securities. Well, now all of a sudden I got a cyber wallet, and I have no account statement that can be forwarded like you could in a securities account, forwarded to the firm. So how do I know what people are actually doing? And I think that we're going to have to see cyber wallets that essentially create audit trails that can be shipped around the street before people are going to adopt this, because otherwise it just facilitates insider trading by securities professionals. The Patriot Act, and this one really concerns me. I'm not sure what these guys are doing right now, but if you take a cyber wallet, the way I understand it, and you take you purchase a bunch of value, and it's not clear, it may be traceable to your IP address, you get rid of the IP, you put it in a cold storage, you move it somewhere else, very hard to trace. So it's going to facilitate has the potential to facilitate bad actors, terrorism, money laundering, drug trades. And I think that I would expect and hope that the US Congress would pay particular attention to how that is going to be addressed. Because to date, most of the financial crimes enforcement choke point in this country and monitoring through the Office of Foreign Asset Control has been through the financial intermediaries, and of course blockchain disintermediates the financial intermediaries. And I think that's very, very, should be of concern to everybody. You know, I was quoted on CoinDesk in an article, misquoted, saying that tokenization of securities, tokenization of assets, tokens were going to solve the liquidity in the IPO crisis. I did not say that. I think that's nonsense. And I'm just going to tell you why. There are some instances where you've got many, many, many steps, and you may be able to replace many of those steps through smart contracts. That's going to help. But the fact of the matter is that markets are not structured in the United States today to support micro-cap liquidity. And most of these tokens are going to be the equivalent of micro-cap small issuance stocks. I'll give you an understanding, which is that academics talk about asymmetrical order book securities, which are big seller, no buyer. The professional money needs to put size to work. And you need financial intermediaries or people in there making commitments, providing salespeople to break up that block of 500,000 tokens, 500,000 shares of stock, and then to hold that price there in place while you create what I call episodic liquidity, find buyers to offset the seller. And a lot of times you would break up in the old days that block of 500,000 shares into 500,000 share orders. And that's how liquidity was manufactured for small cap issuances. As a consequence of the loss of that structure in the United States, we've actually seen a collapse in the IPO market. I'm going to show you some statistics here. And as a consequence, valuations on micro-cap issuances have largely lagged the larger capitalization issuances. And that's really one of the reasons why we have to solve for that problem if we're going to really bring back micro-cap and small-cap markets. And it's not going to be any different in the token business than it is in the securities business. You have to have the economic incentives that are required to provide research. You must have economic incentives to support sales. We've got a market structure right now that really sort of enables and facilitates speculation, not investment. By the way, we're working on a bill in Congress right now. It's called the Main Street Growth Act. It is sponsored by Congressman Emmer from Minnesota. And the idea is to create a new form of venture exchange, which would bring back a lot of what's required to actually make markets. And I'm sure it will be ultimately equally applicable if it goes through. It'll be equally applicable to tokens as it is to securities. And that's going to be essential to kind of getting America back in business, to doing small $25 million, $50 million float public markets. So this is some of the work that we did that led up to the Jobs Act. Just been updated, and I apologize because what you would see is if we cut, these are IPOs all the way back to 1980, and IPOs up through 2017. You're looking at the gross domestic product is the line chart, and you can see that the IPO market sort of fell off a cliff back in 2001 in the wake of what we call the bubble rubble. What I would tell you is that if you saw a breakdown between sub $50 million IPOs and IPOs that were over 50 million, you would see that the entire decline is in the smaller IPOs. They just collapsed. They went from 80% of the market down to 20%, and it happened in 1997 and 98 when the SEC implemented 2 rules. They were the order handling rules and regulation ATS, alternative trading systems. And what it did was it took the trading spreads and it collapsed it from a 1/4 point down to first 3.125 cents or a 32nd pre-decimalization, and then further collapsed it in 2001 with decimalization down to a penny. Not enough money for people to get in there, grab and position stocks and do what I said before, which is take that block of 500,000 shares of stock or tokens and break it down and find 500,000 tokens worth of buyers on the other side. And so that's what the Main Street Growth Act is hopefully going to allow us to get back into the business of doing, assuming it goes through. And if anybody from Congress is watching this, what I would say is it's really important to both Democrats and Republicans. Why? Because more money into more entrepreneurial stage companies creates more jobs. There's multiplier effects. Professor Enrico Moretti at the University of California at Berkeley said that for every technology job created in the economy, there's 5 service sector jobs. Most job creation occurs because of getting capital into smaller companies, and if you can start to do that, you create a velocity of capital money. We start engaging or paying for restaurant workers, hotel workers, and it just feeds on itself. And so what you see now in this particular chart is the number of listings in the United States. And this was, again, work that we did. We actually had an index chart that we used in Congress leading up to the Jobs Act. It was actually very influential in Congress. And it showed that the number of publicly listed companies in the United States declined precipitously beginning at that point that we implemented electronic markets. And other countries were seeing % growth, including China and most of the Asian countries. Europe was actually, we were the worst out of 13 countries that we actually tracked. And so that got Congress pretty motivated. But what you can see here, and I want you to take away one thing, is that the number of listed companies in 2017, these are the operating companies, take out all the noise, which is the exchange-traded funds and REITs, things. These are operating companies only, the kinds of companies that actually find cures to cancer, okay, change quality of life for the better, all that social impact. And we have fewer publicly listed companies in the United States today in 2017 than we did in 1975 on the far left, despite the fact that our GDP, right, has gone up dramatically, okay? On a GDP-weighted basis, okay, these charts should be completely correlated, okay? That's the punchline. So when you look at opportunity cost of the US economy, we've left an amazing amount of personal income, GDP per capita, employment on the table. We have left, because of the quality of companies that we have not financed in this country, the types of companies, we have left tax base, tax revenues on the table. So our deficit is larger than it should be. We have undermined US competitiveness and in turn national security because our capital markets are not functioning to support small public issuances. And so if you do one thing or take one message away from this talk, this is something that everybody in this room needs to advocate for, which is better market structures to support real liquidity where salesmen get on the phone, research analysts can get paid to write research, and market makers can actually get out there and take a position to provide institutional caliber liquidity. That's what's going to cause this market to go from one which is highly speculative and highly volatile to one which is infused with the discipline of fundamental investing, okay? You need that to be able to drive more efficient allocation of capital as opposed to speculative excess where you end up with everybody chasing pets.com. If you remember The Wizard of Oz, I like to say, don't be a scarecrow, think it through, okay? It's a beautiful, exciting technology that is going to really improve lots of lives, but it's got to be done in an incredibly disciplined, technically tied down way and disciplined way. And I think everybody in this room, needs to think of themselves in part as not just a capitalist, but a steward for our quality of markets and the quality of the opportunity that we're going to create, not just for this generation, but for the next generation. This stuff is enabling infrastructure, and it's not go out long and loud, throw a Hail Mary. It's stuff that we need to be incredibly cognizant of and nurture and do it in the right way. I'm actually really thrilled with Aubrey, the work that you're doing in terms of he's taking some leadership in terms of trying to educate people in the market. This is how we're going to make sure that these markets do what they're intended to do, which is support entrepreneurship and economic growth for the long term.